Some of this could be short covering, where people who were short those stocks want to flatten out and take profits. But I think other people are tempted to buy this dip. Those fundamentals aren't going to change in 2023. In fact, they're going to get even worse from the perspective of growth-oriented stocks. And so after this correction, I expect these growth names to roll over and make new lows.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, and a prominent Bitcoin critic, warns all investors to be careful about Bitcoin. Before listening to him, please ensure to smash the like button and subscribe to the channel.
All of the major stock market averages in the U.S. finished the day with strong gains. The Dow Jones Industrials is up better than 330 points. That is a 1% gain. The S&P 500 rose by 1.9%. The Russell 2000, 1.7%. And the NASDAQ was up 2.8% on the day. In fact, the NASDAQ is the only one of those four market indexes to finish the week in the black. The other three indexes lost ground on the week, despite recovering most of those losses on Friday. And in fact, all four of these indexes still have gains on the year. But what's going on so far in 2023 is you're seeing a reverse rotation out of the value-oriented stocks that did well in 2022 into the beaten down growth-oriented stocks that fell apart in 2022. Now, a lot of people are obviously betting that there's going to be a rebound in those names. Now, some of this could be short covering, where people who were short those stocks want to flatten out and take profits. But I think other people are tempted to buy this dip. They're bottom picking. They think if we buy some of these really beaten down names, those are the names that are more likely to recover in 2023. But I think the fundamentals that were driving the rotation out of growth stocks into value stocks in 2022, those fundamentals aren't going to change in 2023. In fact, they're going to get even worse from the perspective of growth-oriented stocks. And so after this correction, I expect these growth names to roll over and make new lows sometime in 2023. In fact, I think early in 2023, these gains are going to be lost and these stocks are once again going to be sold, because the rotation from growth to value didn't end in 2022. That's when it began. And I expect it to continue in 2023. And it's not just the rotation from growth to value, but the rotation from domestic to international. In fact, even though the U.S. stock markets are up on the year, the international markets are enjoying even greater gains, especially when you factor in the weakening dollar, which is accelerating the size of the gains on foreign stocks when measured in depreciating U.S. dollars. And not only are we seeing a rotation from U.S. stocks into foreign stocks, I think we're seeing another rotation from developed markets into emerging markets. And these are new trends that are only just beginning, and I think they have a lot of legs. And I think one of the trends that may have the most legs is the trend developing in gold. Gold once again hit a new 9-month high on the week. We almost got to $1,940 an ounce. I think we settled up around $1,927. That wasn't a big gain on the week, maybe up another $5 or so, but we continue to climb a wall of worry in this bull market in gold. Now, one of the reasons you know we're climbing a wall of worry is looking at the tepid reaction we're seeing to these new highs in the price of gold in gold stocks. In fact, gold mining stocks actually slipped a bit on the week, although they did have decent gains today, even though gold was a bit softer on the day. But gold stocks would have to rise about 30% from here to get back to where they were 9 months ago, when the price of gold was the same as the price is right now. And what this is telling me is that a lot of the gold traders are nervous about this gold rally. They expect it to reverse. If they believed in this rally, then they would want to participate by buying these gold stocks, because gold stocks generally are forward-looking. And so if you have a optimistic outlook for the future price of gold, you would be more inclined to buy gold stocks than the metal itself. But because most investors don't have that optimistic outlook, they're not buying these names. And that is one of the reasons that I expect this rally to continue, is that it's on nobody's radar. Nobody is paying attention to it, and those who are don't believe in it. And I think one of the reasons that people aren't paying attention to what's happening in gold is they're being distracted by the sideshow that's going on in Bitcoin. Because gold's 6% or so gain so far in 2023 pales in comparison to the 35% or so gain that we see in Bitcoin. Bitcoin is trading at around 22,500. Now, I didn't even think that Bitcoin was going to get above 20,000, let alone 22,500. And since we've managed to overcome that overhead resistance, certainly it's possible that we could see a bigger rally. Maybe we can get closer to 30,000 on this rally. Now, it may stall out long before it hits 30,000, but I certainly can't rule out that possibility, because what's going on right now is investors are buying the lowest quality names. And I can't think of an asset of lower quality than Bitcoin. And so that's what's going on. In fact, if you look at the gain year to date in the Grayscale Bitcoin Trust, it's up 47% so far in the year. So despite the fact that the parent company of the Grayscale Bitcoin Trust is about to declare bankruptcy, and all the other problems that we're having in Bitcoin and crypto in general, speculators are still snapping up Bitcoin and shares of the Grayscale Bitcoin Trust. Now, even though Bitcoin is up about 35% so far this year, it's barely made a dent in the 65% decline from last year. In fact, even at 22,500, Bitcoin remains close to 70% below the all-time record high that it set in late 2021. But the big difference in the gold rally and the Bitcoin rally is that the gold rally is sustainable and the Bitcoin rally is not. Gold is rallying in a bull market, Bitcoin is rallying in a bear market. And while gold is going to be hitting new all-time record highs, Bitcoin is going to be hitting new lows. Obviously not record lows, because the record low is barely above zero, but it is going to be taking out the low that it hit in 2022, in 2023, probably around the same time that gold is hitting new all-time record highs. Now, the reason you're getting all this optimism in Bitcoin and a lot of their other assets is that investors are factoring in the Fed pivot. Most people expect the Fed to finish the tightening cycle sometime in the first half of the year, and in the back half of the year, they're anticipating that the Fed starts cutting interest rates. And it's this anticipation of the pivot that is driving this move back into speculative assets. But what the market doesn't understand about the pivot is that if we get it, it's not going to be because the Fed has been victorious in its battle against inflation, but because it has surrendered. And the reason it's going to surrender is because it's going to want to fight a different battle against recession and potentially a financial crisis, because we're not going to have a soft landing, we're going to have a hard landing. And a hard landing with higher, not lower inflation is not bullish for growth stocks, it's bearish. And it's not bullish for Bitcoin, it's even more bearish. But what it is bullish for is gold. And what it's very bearish for is the US dollar. So sometime soon, I expect markets to start reflecting this reality instead of the current fantasy. Now, one of the reasons that so many investors are expecting the Fed to pivot is all of the weak economic data that continues to come out, including the weak economic data that we got this week. While tech stock prices were rising on the week, their head count was falling. On Friday, Google announced that it's laying off 12,000 workers. That's 6% of its entire staff. This is the largest round of job cuts ever in the history of the company. Now, that follows an announcement earlier in the week from Microsoft that they were going to be cutting about 10,000 jobs. Remember, late last year, we got about 18,000 job cuts coming from Amazon, I think 11,000 from Meta. I was talking about this all last year, not just late last year, but throughout the year on my podcast. I was warning that job cuts were coming in tech, and they're still coming. This is not even close to the end of the layoffs. We're still near the beginning of what's going to be massive reduction in the workforce of these companies. And of course, some of the companies are going to see 100% reduction in their workforce because they're going to end up going out of business. And all of this is going to add to the problems for the economy, but also it's indicative of problems for these companies. Now, the initial reaction to the job cuts may be a boost in the stock price because the immediate effect is lower costs and so higher profits. But the reason these companies are laying off staff is because the business outlook for their goods and services is deteriorating. And so if the company is going to do less business, it needs less workers. But ultimately, the fact that it's doing less business means there's going to be lower profits. But it also means that the growth rate of those profits is coming down. And a lot of these tech stocks, of course, trade at high multiples. And those multiples are a function of two things: interest rates and growth rate. The lower the interest rate, the higher the stock price. The higher the growth rate, the higher the stock price. But we have two things happening. We have interest rates going up and growth rates coming down. That's a double whammy on valuations. And so after this sucker's rally ends in these tech stocks, look for the sector to make new lows. In the meantime, the laid off workers who have to replace the job they lost are most likely going to take a job that pays less than the one they had, because these tech companies were among the highest paying jobs out there. And so workers are losing good full-time jobs, benefits, high salary. And when they go into this weak labor market, they're likely to have to settle for 1, 2, or 3 lower paying, maybe full, maybe multiple part-time jobs without benefits to take their place. And they're going to end up with lower overall earnings, but they're having to spend more time to generate those earnings. And all of this is ultimately another negative for an already weak economy. In fact, during the week, we got a lot more economic data that supports my thesis that the economy is in fact weak and getting weaker. Earlier in the week, we got the Empire State Manufacturing Index number for January, and the consensus was for minus 8.1, and that would have been a slight improvement over the minus 11.2 that the index measured in December. The range of estimates went from a high of minus 3.1 to a low of minus 11. The actual number came out at minus 32.9. Now, that is the weakest number we've had since May of 2020. And of course, in May of 2020, we were under full COVID lockdown. So you have to go back to that time period to find an Empire State Manufacturing number that low. In fact, this is the 5th worst reading in the history of that survey. If that wasn't bad enough, the following day, we got the retail sales numbers for December, and there was supposed to be a drop of 0.8, and that would have followed what was originally reported as a drop of 0.6 in November. Well, the November decline was ratcheted up to down 1%, and the December decline ended up at minus 1.1%. So a bigger decline than people thought, and a downward revision to what was already a decline in the prior month. And in fact, if you X out vehicles, the prior month's drop of 0.2% was revised to a larger drop of 0.6%, and what was expected to be a 0.5% drop in December ended up being a 1.1% drop, and that was way worse than the upper range of the consensus, which went from a gain of 0.4 to a loss of 0.8. And then if you take out vehicles and gasoline, the same thing. The prior month's minus 0.2% was revised to a minus 0.5%. And while they were expecting minus 0.1% for December, we actually got minus 0.7%. Again, well above the worst case scenario contemplated by the consensus, which ranged from a plus 0.5 to a minus 0.2. And remember, none of these numbers are adjusted for inflation. So despite the fact that everything we're buying costs more, we're still spending less. And so that means real sales are plunging because people are buying a lot less. They're just paying a lot more for what they're buying. But even with the higher prices, overall sales are still declining. Also on the same day, we got the release of the December industrial production numbers. And once again, much worse than had been expected and more downward revisions to previous months. So the industrial production number for November was originally reported as minus 0.2. That got revised to minus 0.6. It was supposed to come out as minus 0.1 for December. Instead, it came out at minus 0.7. Manufacturing output also weaker than forecast. The minus 0.6 from November was revised to minus 1.1, and instead of getting a minus 0.2, we got a minus 1.3. That blew away the consensus, and again, way worse than the range of forecasts, which went from a high of minus 0.1 to a low of minus 0.5. Remember, we got minus 1.3. And then even capacity utilization tanked. It was supposed to come in at 79.5, which would have been a slight decline from the 79.7 from November. Instead, they revised down November to 79.4, and then December collapsed all the way down to 78.8. Again, way below the range of estimates that went from 79.3 on the low end to 79.7 on the high end. We blew away the low end. These are all bad numbers if you're hoping for a reduction in inflation, because what they show is that the economy is less productive. If we're not producing as much stuff, then the stuff that we are producing is going to be more expensive because we have a reduction in supply, we still have demand, and so prices are going to go up.